Today, we're diving into the world of bond trading, how it works, why it's important, and how professional traders profit from it. If you want more expert-level trading insights, hit that like button and subscribe. We'll cover how bonds are traded in institutional and retail markets, how interest rates and macroeconomics influence bond prices and trading strategies, and the top 5 bond trading strategies used by experienced investors. Let's get to it. First, how are bonds traded? Unlike stocks, bonds are primarily traded over-the-counter (OTC), meaning transactions happen directly between institutional players, banks, hedge funds, and sovereign wealth funds. However, traders can access bonds through electronic platforms like Bloomberg Terminal, Tradeweb, and MarketAxess. For retail investors, brokers like Interactive Brokers, Fidelity, and Schwab provide access to corporate and government bonds. The most actively traded bonds include U.S. Treasuries, T-bills, notes. Bonds, as a risk-free asset, it influences global markets. Corporate bonds offer higher yields but vary in risk. Municipal bonds provide tax advantages for high-net-worth investors. Emerging market bonds can be more volatile but offer higher return potential. As a trader, the key principle to remember is that bond prices move inversely to interest rates. When interest rates rise, bond prices fall because new bonds offer better yields. When rates fall, older bonds with higher fixed rates become more valuable, pushing their prices up. This means that macroeconomic indicators such as inflation data, Fed rate decisions, and global economic conditions directly impact bond trading strategies. The yield curve is also a crucial signal. A normal yield curve, inverted yield curve, and flat yield curve each indicate different expectations and opportunities. So, what are the top bond trading strategies used by experienced investors? Number 1. Yield curve trading, spread trading. Traders can take positions on different points of the yield curve. A flattener trade, for example, involves going long on short-term bonds and short on long-term bonds if the curve is expected to flatten. Number 2. Duration and convexity trading. Short-duration bonds have prices that react less to interest rate changes, while long-duration bonds are more sensitive. Traders may increase their exposure by using futures or swaps to hedge against duration risk. 3. Bond arbitrage, relative value trading. This involves long-short strategies using Treasury futures and corporate spreads. An example is taking advantage of temporarily mispriced on-the-run and off-the-run Treasury bonds. 4. Credit spread trading. Traders profit from changes in corporate bond spreads over Treasuries. Widening spreads indicate increased credit risk, while narrowing spreads show improving credit conditions. 5. Macro trading with bonds. This involves positioning in bonds based on global economic shifts and monetary policy expectations. If inflation is expected to rise, for example, traders may short long-duration bonds or use inflation-protected securities. Tips. Where and how are bond trades executed? For institutional trading, platforms like Bloomberg, Tradeweb, and MarketAxess dominate. These platforms provide liquidity and automated execution tools. For retail traders, access to the bond market is growing. Platforms like IBKR, Schwab, and Fidelity offer direct purchases and access to the secondary market. Hedge funds and algo traders may also use bond futures like U.S. Treasury futures on CME, and bond ETFs like TLT and HYG for leveraged exposure and hedging. And there you have it. Thanks for tuning in. Hit that like button for more bond trading insights. See you in the next one.